Another sign, though, of recovering sentiment for the UK, house prices rose in May. The latest nationwide Building Society report shows that the average cost of a home went up by 0.3% this month. That reverses a drop of 0.2% in April. But Nationwide says further gains will be limited by the slow pace of growth in the country. For more on this, let's speak to Nationwide's chief economist, Robert Gardner, who joins us live now from Swindon. Robert, good to see you there. To what extent are house prices a gauge of how the economy is doing?
Well, I think really the sort of pattern that we have at the moment with a very subdued housing market is reflecting the very subdued conditions in the wider economy, and especially for households. Household budgets under a lot of pressure, wages aren't keeping up with the cost of living, unemployment still well above pre-recession levels. So the difficult position of the economy, difficult situation facing households in particular, is what's weighing down on the housing market. A very flat picture, but we hope things will gradually get better, but progress is likely to be pretty slow.
We were actually quite surprised to see that a small amount of growth in the market, given what the country is facing right now.
Well, the pattern that we have at the moment, you mentioned the 0.3% gain we have, only just offsetting the 0.2% fall we had the previous month. And that sort of flattish picture really has been the pattern dominating over the last 9 months or so. Prices basically unchanged over the last 9 months. So a stable picture, really reflecting the fact that the economy is pretty stagnant at the moment. What we think will happen next is that as the recovery gradually gathers momentum, it'll eventually filter through to households, boosting confidence, boosting the labour market, and ultimately giving a lift to the housing market. But it's going to take a while for it to come through because the pace of the recovery is pretty slow, and the pattern of the recovery isn't much good to households at the moment either. It's going to be driven by net exports and business investment rather than household spending. So the feel-good factor is not going to be there for households for a little while yet, I wouldn't have thought.
And certainly if Mervyn King and his chums at the Bank of England put up interest rates.
We don't think the interest rates are likely to go up really until the back end of this year, and even then the interest rate increases are likely to be very gradual because the recovery is very sluggish. They think that high inflation is really being driven by these one-off factors, that domestic inflation really isn't a problem. So interest rates should rise only very gradually, but you're absolutely right, when they do start to rise, they will be yet another headwind for an already pretty embattled household sector.
It's interesting that you say that because, you know, here in Britain people do have these extra costs. We mentioned the VAT cost that's put the inflation price up there at the moment, but we know that wages are being squeezed. There is a lack of confidence generally in the economy. When interest rates do go up, people are going to feel that when they're paying their mortgage.
Yes, the fact that there are more people on variable rate mortgages now compared to before the recession began, that also means that a 25 basis point increase now will probably feel a little harsher for the overall economy than it did before the crisis, because more people will be exposed to that interest rate increase. Nevertheless, if interest rates are rising because the economy is strengthening, if the broader economic backdrop is improving, then households and the housing market should be able to cope with higher interest rates. It's just going to be a factor that's going to act as a drag on any improvement.